Hello and welcome to our investment strategy outlook for 2023. Fighting inflation is a long haul and will continue well into the new year. With tighter monetary conditions, we will see recessionary episodes in major economies. But despite the hardships, short recessions should not leave deep economic scars. In the US, high interest rates are already hurting demand and private investment, especially in housing. As US inflation slows, rates should peak at around 5% in early 2023. While aggressive monetary tightening will have a considerable near-term impact on growth, falling inflation, healthy balance sheets, and a strong labor market will pave the way to a US recovery in the second half of the year. Europe's challenges are different. The economy already faces recession, while gas reserves will help to avoid a worst-case scenario this winter. Energy supplies still need alternatives for next year. In 2023, we expect growth of 0.4% and peak policy rate at 2.25%. In contrast, China's reopening economy is set to grow by 4% in 2023. Fiscal spending and monetary support will mitigate this volatile process. Better Chinese growth should also provide a much-needed boost to world trade. Globally, we can't exclude the risks of monetary over-tightening and impact of higher housing costs, but we do see a recovery by the end of 2023. Let's now hear from Stéphane how investors should navigate the year ahead.
Between a recession and recovery, 2023 will mark a pivot point. These two distinct economic phases demand two distinct portfolio constructions. In the first phase, investors need to position for the recession that Samy just described. That's why our investment strategy remains prudent. Overall, we favor quality assets because they can resist slow growth and the rising cost of capital. In equities, in addition to quality, we also like value stocks as well as healthcare and energy. We continue to build asymmetric profiles for our clients' portfolios using put spread options on US and European equity indices to protect them from any downsides while benefiting from any potential upside. Pressure on corporate earnings is still a key concern for stock markets. In fixed income, we like government bonds and investment-grade credit because their yields now look attractive after years of low or even negative rates. In alternatives, we added global macro and trend-following strategies to diversify our client portfolios further. In currency markets, we favor the US dollar and the Swiss franc. Our cash position also gives us the flexibility to seize opportunities quickly as we approach the second phase. The turning point will come when market sees US rates peaking and economic activity reaching a floor. In equities, that will create opportunities in cyclical and growth stocks as well as emerging markets. In fixed income, we expect high-yield credit and emerging market debt in local currency to play a role in portfolios again. At this stage, it will also make sense to reduce exposures to the US dollar and increase the Japanese yen, the euro, and some emerging market currencies. And finally, we'll raise gold exposure. The turning point will, of course, greatly depend on geopolitics as well. The Ukraine war's uncertainties and strategic competition between the US and China will continue. Another long-term trend, friendshoring, will keep reshaping global supply chains and trade. These elements will create new opportunities and sources of investment returns, as in every economic transition. This is especially true in sustainability, where the energy transition is accelerating significantly. Now, it just remains for us to wish you and your loved ones a healthy and happy new year. Thank you very much for watching.